Hello, and welcome to our April market update. My name is Doug Johnson. I am the Senior Investment Strategist here at HCM, and today I'm joined by my associate, Dan Rinck, who's an investment strategist and also a member of our investment committee here at HCM. Dan, how are you feeling today?
Uh, Pretty good.
Yeah,
I'm glad the storms are over,
yeah.
honestly. I mean, happy to be through that with the little babies, but
Be dry. I'm assuming you're talking about the weather, not the market.
yeah, the weather.
Yeah.
Not the tariff storm.
Okay.
We can talk more about that.
Sure. Well, why don't we just jump right in? So obviously we've seen a tremendous amount of volatility over the past few days, and really we want to take the time today to kind of touch on that, give a quick recap of what's happened, um, kind of give a market reaction update to that, and then explain what we at HCM have done from a portfolio perspective, and then kind of what next steps might be as we move through this. So, obviously, the tariff word is the word du jour. We've had kind of fast moving information coming over the past few days. Everyone had April 2nd circled on their calendar as quote unquote Liberation Day. And I don't want to go through line item by line item all of the tariffs that were implemented. So let's just try to touch on a few of the main points here. Um, I think the takeaway is that you had a wide range of forecasts for what the initial announcement was going to be, ranging from just a flat tariff across the world to more targeted tariffs in terms of countries and industries. And I think what came out could be described as kind of the nuclear option, and was considered by many to be worse than the worst case scenario in terms of how aggressive this was going to be. Um, and the market reaction was quite swift. I mean, we saw a 5% sell off in the S&P on Thursday, which is not a small move by any stretch of the imagination. And Dan's going to get into some more detail on some other parts of the market there. But then overnight, you had China with a retaliatory tariff. It's kind of a tongue twister, saying that they are going to strike back, and now that has also weighed on market sentiment, and we're seeing a follow through of the sell off that we saw yesterday. And I think the question going forward is, is this the end? Or are we going to see the EU step in? Are we going to see Japan step in? Like, how far is this going to go before we see a stopping point? And I think that's creating a tremendous amount of uncertainty and concern in the market. So, this is titled "Bears Everywhere." So this just shows the AAII bearish percentage going back to 1985, we'll call it. And you can see that green line that goes across there. You've only had three instances since that time where the percentage of that survey has had a higher representation of people who are saying they're bearish than bullish. The other times were October 18th of 1990, which is almost 45 years ago. I'm sorry, 35 years ago. My math's a little off there. And then you have March 4th, 2009, which was the bottom, or 2 days before the official bottom of the great financial crisis. So, you're talking about times where, you've had just significant despair in the marketplace, and we're there right now. So, granted, the forward returns from those points look very good, but this, the amount of negative sentiment we're seeing in the market right now is pretty crazy. In addition to that, you have the question of are these tariffs going to cause enough uncertainty to spill over into economic growth and cause a recession, and why that's important. So you look at the history of 10% S&P corrections here. And we've got 2025. This chart is probably a week or two old, so it's not updated to reflect the last 2 days. But I think the takeaway here is you can see that there's a clear delineation between the path for a market after a correction that has a recession and that doesn't have a recession. No recession corrections usually present buying opportunities, whereas recessionary corrections usually represent selling opportunities. Now, the trick is it's hard to tell which one you're going to go into in the future, but the concerns about recession going forward, I think, have increased substantially over the past few days, and I think are very real at this point. And I think the question is, do these tariffs become policy or do they become politics? If they're politics and they're negotiations, this will find an endpoint. Hopefully, with a negotiation where there can be a unilateral agreement that's good for everyone. But if it's not, and this is long-term policy, I think that the risk of economic damage here, at least in the short term, is very real. So this is an extremely fluid situation, but you can see the line for recession versus no recession is significant for something like this. So we've talked about the volatility that we've seen. So Dan, can you kind of walk us through some of the highlights or lowlights, so to speak,
There's
of
a
what
few
we've
highlights.
seen?
Yeah, so again, for reference, we're recording this video at about 10 a.m. on Friday morning. We had the 4% plus down day yesterday. Last I checked, we're down 3.4% so far today. And this is actually updated pretty recently. I did it about 15 minutes ago to give us some good data. So what this chart shows is just kind of the main asset classes that we track and what's been going on so far year to date. So this is a year to date time frame. So for starters, we have the S&P 500 in that dark, thick black line. It's had a pretty tough go at it so far year to date. Um, we've seen a lot. We were cusping on kind of a normal 10% pullback, and then we had, our Liberation Day, and you saw a very swift correction to the downside. Um, the main issue and laggards so far year to date have been the Nasdaq 100 and small caps. We've seen them face a lot of damage so far year to date. Um, it If you are overexposed to tech, you've felt a lot of pain. We are cusping on bear markets for both. That is a 20% pullback in both those asset classes. And if you look at the chart, obviously a very, very short time. So it's been very aggressive and, very punishable selling so far for those two asset classes. Um, we also have in that green line IWD, which is our value names. IWD is the Russell 1000 Value Index. It has fared a lot better, honestly. You've seen over the last few days a lot of a defensive rotation. Typically, when you get this really exhaustive selling, you'll see a lot of those names fall as well. But yesterday, on a 4% plus down day, you saw a lot of names that were actually green for the day. So it wasn't, you know, selling anything with impunity. It was actually rotation into these defensive sectors. So seeing that rotation is definitely a good sign. It can mean two things. It can mean that investors are just repositioning their equity allocations and reducing that large tech overweight that the S&P 500 has been anchored to for a while and moving into more value and dividend growth type names. But at the same time, it could also mean that we don't have selling exhaustion yet. Um, Selling exhaustion happens when basically investors look across the board and say, I have equity exposure, I want to sell it. So we weren't really seeing that yesterday. Again, this morning we definitely saw a little bit of a dip, which could basically tell us we might be looking at some exhaustion, which would be a good sign. And then at that top line there, SCHZ, that is our Schwab US broad bond index. It follows the US aggregate bond index. That's actually positive so far year to date. We're looking at over 4% returns for bonds. I know um, a lot of investors have kind of shunned the bond side after 2022, saying, I never want to own bonds again. Why would I own bonds if I, can buy money market and get a good yield? Bonds have definitely held their end of the bargain so far in
So
this market cycle.
we've definitely seen a different reaction than what we saw
Absolutely.
in 2022, where you had that double-barreled,
Yeah.
um, underperformance with both equities and bonds.
And I mean, it's really insulating portfolios a lot better so far this year. I mean, 2022, it felt like wherever you looked, you were seeing red numbers. Um, this year, bonds are really doing a good job of cushioning the blow and, working in an uncorrelated fashion. So we have clients that are holding bond allocations, and we also have clients holding bond ladder allocations that are in retirement or taking distributions. Bond ladder clients obviously have protected all of that money for their distributions for the next 3 to 5 years. Those have been perfectly stable and actually enjoying a little bit of a rally as well. So, bonds have been a great place to be so far. Um, International's performing pretty well as well. I didn't put it on here. It's tracking pretty close to the value index. So international stocks are holding up. I didn't really include that in this just because um, as of Liberation Day, they're seeing some pretty punishing action in international, and we really need to see the dust settle to see what kind of that trend looks like going forward.
So a lot of a lot of negative news. Is there anything positive that we can take out of what's going on right now?
Well, I mean, when you look at it, going up for this whole entire rally out of the 2022 bottom, it's been kind of an earnings driven rally. Um, these companies were making money. They were being very successful on the actual business side of it. And not much of that has changed. Some earnings projections here on this chart. These are consensus expected earning estimates for the next 12 months for the S&P 500, S&P 400, which is mid caps, and the S&P 600, which is small caps. And, as you can see, we're up to this point. This was updated on April 2nd. We're not really seeing these earning estimates being adjusted. Now, even if they get adjusted down slightly because of tariff news or anything like that, they're still very well in a strong positive trajectory. Um, and if you're looking at kind of this market action and these earnings don't get affected, if these earnings continue to come in strong, this is 100% without a doubt a buying opportunity. Now, this is something we track very closely because earnings really inform our decision. Um, if we start to see earnings estimates come in lower, or um, you know, we have consensus CEOs coming out saying business is going to be tougher because of tariffs and it was going to affect the bottom line, then we might really make some decisions based on that. But so far, even with all the tariff talk, even with kind of the valuation concerns, earnings have been the main driver, and so far we're not really even seeing a blip on the radar on the earnings side. Um, so it's looking pretty good from that point of
Yeah,
view.
and I think going back to the policy versus politics, I think that the shorter this tariff war, we'll call it, goes on, the less affected I think you'll
Yeah.
see earnings. But the longer that it goes on, I think it's probably reasonable to expect that you would see some downward revisions to this to some of these numbers. So this obviously is it's a bright spot in the storm right now. Hopefully, it can remain that way. But I think with the level of uncertainty that we've seen, there's
Yeah.
certainly some questions.
Yeah, I mean, in the first kind of tariff go around in Trump's first term, it felt like it was used as, a negotiating piece to come to the table. And
Mhm.
and so far, I think what's making our investors so jittery is that it just seems like he's trying to punish people.
Yeah.
And maybe that's all a part of the deal. really try to say, hey, I'm serious this time to get even more leverage. But the reason we're seeing so much volatility is the fact that people aren't really seeing a light at the end of the tunnel. Now,
Mhm.
we can come in Monday and things could be completely different from a tariff perspective, but it's hard to see through that uncertainty at this point.
Yeah. Yeah, I would agree. And I think that's kind of a good breakdown of what we've seen. And I think the main concerns around, what these tariffs might or might not do. Now, what have we done, from a portfolio perspective? So, we have recently uh, taken, roughly 6 to 8%, depending on what kind of model you have, out of equities over the course of the last 2 weeks, and that was before the sell-off yesterday. And that was kind of in response to the increased uncertainty that we've seen due to this. So we have been reducing risk in recognition that those risks have increased. Now, one question that I think pops up a lot of times as well, why didn't you do more, or kind of how do you think about this? And this is probably a good time to just remind clients that we have a process in place to deal with volatility, and whether that volatility is caused by tariffs or a terrorist attack or a virus, or you pick whatever it is, the market usually reacts the same way. It's either going to be very violent, or it's going to be more measured. But there's what I would call signposts along that road that will kind of give us an indication on what the chances that something that starts out as a 5% move could turn into a 40% move, because they all start that way, but not every 5% move turns into a 40% move. So we have a very kind of staggered way of adjusting our risk exposure. And it's done in a very data driven way, in a very objective way. Because what I will say is emotions in a market like this are absolutely your worst enemy. And we try to take that as much as possible. So, that process has worked well for us. We ran it in 2022 very successfully. And we're going to look to that, to help guide our decision making here going forward. And the market internals right now they've certainly weakened. What I will say though is part of that process is recognizing when we've reached a point where the reward outweighs the risk on a forward-looking basis. That doesn't mean calling the exact bottom. It doesn't mean you couldn't see more volatility in the short term, but you do get to a point in every sell-off where that relationship changes enough to where it's worth putting money back to work and being a buyer. What I'll say is as of this webinar right now, we're not there yet. We're probably closer to looking to reducing risk further, as opposed to buying quite yet. But in a market that's moving 4 and 5% a day, that can change quickly. But what I want to reassure clients about is that we're not just waking up in the morning and sticking our finger in the air and saying, "Yep, today feels like a good day to buy or feels like a good day to sell." That's never a good strategy. We've got a very objective plan in place in order to deal with this. We have already enacted that plan. We will continue to use that as our guideline going forward. And what I would say to clients is, if you want more information on this, or you want to talk more about this, feel free to reach out to us, and we're happy to kind of walk through it with you. I guess I'll end this by showing some slides that I think provide some perspective, and I always try to provide perspective in times like this because I think it's important, because we can definitely get caught up in the day-to-day volatility of what we're seeing right now. Everybody has access to real-time quotes on all markets. They can look at their accounts in real time. So you can certainly have a very up to the minute assessment of what's going on. But we try to think of things a little bit differently. And if you put 2025 into perspective against every year going back to 1980, you can see that the max pullback throughout the years, there's been a lot of instances where you've seen decent pullbacks throughout the years. Normally you have a chart where that black line is at zero. This one's actually at negative 14%. It shows the average max pullback during the year going back to 1980. And then those blue bars are what the S&P actually returned for the full year. So you can see there's many instances where those diamonds are closer to that 14%, and the S&P return has actually been positive for the year. Now, this may be completely coincidental, but when we looked at that chart earlier, the S&P was at what? Dan, negative 13.8?
Yep.
Something around there. So again, that is not me making a call that this is the end of this. It's simply recognizing that volatility is normal. Sometimes that volatility is more extreme than we're used to and feels different, but it's normal. The other thing is, if we go back to the March 2009 low, so the end of the great financial crisis, and look at every S&P 500 correction greater than 5% since that time, you've got 26 instances, I'm sorry, not 26. That's the number of days, but you've got roughly 25 to 30 instances where you've had situations like this. And these declines range from anywhere from just around 5% to as high as 35. But what you'll notice is on the right side of this, every time you've had these things happen, there's been a narrative or a reason around this. And in any instance, that could have grabbed hold and turned into something worse. So the reason I bring this up is because I think a lot of times people like to look at this in retrospect and say, wow, this was so obvious. When the reality is it's not as obvious as it seems, because all of these instances we recovered from. Some of them lasted longer than others, but you don't necessarily know if this is going to be the next, COVID situation, or it's going to be the next, European debt crisis where we saw, a 10% correction, or you saw a 15% correction in May of 2015, where there was concerns about the China stock market crash. So there's always going to be things around this. So tariffs, trade wars, recession fears, those are the things right now. But it doesn't necessarily mean that this time is different, and this way will play out in its own unique way. And I think, as I mentioned earlier, we have a plan in place to deal with this type of volatility and movement in the market. Now, if we take a step back and we go 5 years out and we look at the S&P, we see a little bit of a different picture. Yes, that line to the far right is going down, and it's going down hard, from a little over 600 down to 522. So this is the SPY, which is basically the S&P 500 index ETF. But if we go back 5 years, the bottom of that line starts right around 240. So that's a pretty significant move higher in 5 years. And we have to remember that markets generally move higher. They don't move higher all the time, but over the long term, they do. So, bouts of volatility are going to happen. It's normal. It's almost the price of admission to be an equity investor. So, we always encourage clients to kind of take a step back in times like this and understand kind of where we've come from. And when you look at it, I think from this perspective, granted, this still feels bad, but we've still been generally positive in terms of returns over the past 5 years. So, with that, what I will say is that if you are having significant stress, if you are having trouble sleeping at night over what you're seeing in your portfolio, please don't hesitate to reach out to us. We can talk through it. We can have a conversation, or we can determine that, you're just not in the correct model. Your risk tolerance is off for whatever reason. But our goal is to make sure that clients feel as comfortable as they can with the plan and the model that they have in place. They're not always going to feel perfect about it, but that's kind of what volatility is. And as a reminder, this is a very fluid situation. So we are going to provide updates frequently, more than likely. The way that we're seeing market movements right now, you could be seeing buying and selling over the course of a week. If we're seeing, weeks where like we've got right now, where you've got, 8, 9, 10% moves. I mean, that's a year's worth of returns in the S&P in a few days. So, as always, if you have questions, comments, concerns, please reach out to your advisor. We want to be a resource during times like this. We want you to feel confident in what we're doing with your money. We want you to feel confident that we have a plan in place to deal with what's going on. And what I will say is this too shall pass. At what time frame and what level in the market is yet to be determined. But I think sometimes we tend to anchor to extremes in a lot of things, and especially in the market. I mean, some of the comparisons that I've seen taking place over the past week they're astounding. I mean, I've seen Great Depression charts, people talking about that being a possibility. So, it's important that we keep proper perspective, and we are certainly here to help clients with that. Again, you may hear from us sooner rather than later if the volatility continues to pick up. But if you have questions, comments, or concerns, please feel free to reach out to us, and we want to be a resource for everyone in this time. So what I will say in closing is, try to enjoy your weekend as best you can, and we hope to hear from you in the short term if you are having any kind of concerns or questions about your portfolio. I want to thank Dan for joining us today. Great information as always. And hopefully we're past the eye of the hurricane here.
Yep.
Yeah. All right. Thanks, everybody.